30 Lessons from the Little Book of Common Sense Investing. Invest in low-cost index funds rather than individual stocks to maximize long-term gains. The stock market is unpredictable in the short term, but trends upward in the long term. Compounding works best when you invest early and stay invested for the long term. Stay the course, even during market downturns, as the market recovers over time. Don't try to time the market. It's impossible to predict the highs and lows accurately. The cost of fees and expenses can significantly reduce your returns over time. Diversification reduces risk and increases the stability of your investments. Avoid chasing after hot stocks. They often cool down quickly. Reinvest your dividends to benefit from compound growth over time. Focus on the long-term performance of your investments rather than short-term fluctuations. The majority of professional fund managers fail to outperform the market in the long run. Buy and hold. Frequent trading can erode your returns with transaction costs and taxes. Stock market bubbles will eventually burst, so avoid investing based on market hype. Overconfidence can lead to risky decisions. Be humble about your investing knowledge. Patience is key. Wealth accumulation through investing takes time. Dollar cost averaging helps reduce the impact of market volatility by spreading out your investments over time. The lower your investment costs, the higher your returns will be over time. Avoid emotional decisions. Fear and greed can cloud your judgment and hurt your returns. Bonds provide stability and reduce the volatility of your overall portfolio. Focus on your investment goals rather than comparing yourself to others' returns. The economy and the stock market don't always move in sync. Stay invested through economic ups and downs. Don't fall for the illusion of control. Market movements are out of your hands. Don't rely on past performance when choosing investments. It's not an indicator of future success. Your investment horizon should align with your financial goals. Beware of investment products that promise too good to be true returns. Be cautious of market noise. Ignore media hype and stick to your strategy. Don't be swayed by short-term market losses. Stick to your investment plan. The more you trade, the more likely you are to make costly mistakes. Time in the market is more important than timing the market. Stock market declines are inevitable, but staying invested leads to recovery and growth. If you found this info helpful, hit that like button, share this with someone who needs to hear it, and don't forget to subscribe for more money tips and tricks. Got any thoughts or questions? Drop them in the comments below, and I'll catch you in the next video.